for a woman in the UK, if she dies at the most common age for a woman to die in the UK, because they live longer than men, could spend a third of her life in retirement. If you are really into crypto, then the hours that you're going to have to put into it to do it well, it's not going to feel like work. It's going to be something that you want to do anyway. If you've got zero interest in crypto, then you should not be doing it. Starting a business can be an incredible way, probably the best way of changing your life financially. But if you just hate the idea of doing it, then you shouldn't be doing it, because it'll make you absolutely miserable and you probably won't succeed.
Before we dive into this episode, I want to ask you to hit the subscribe button here on YouTube. It helps keep growing the channel and keep getting fantastic guests like this one. Rob, welcome back to the podcast. It's great to have you again.
Thank you for having me. Really appreciate you having me back on.
And last time round, I really enjoyed the actionable elements of the price of money. And I'm super excited to get to chat to this one again, because once again, it's one of the ones where listeners can get their teeth into it from a personal finance perspective and actually go away with information and action that they can move forward with and hopefully improve their situation, because it's certainly not easy right now.
It's not. And I think my last book, The Price of Money, it felt like it was a problem book with a little bit of solution as much as I could within the confines of that. Whereas like this is just like full solution. It's like, that's how the world is. Nothing you can do about it. So now this is how to act within that. And so actionable, I think, is the word. That's what I set out to do with this book.
Yeah, I'm on board with that. And I think acknowledging that we are in a problematic environment is probably one of the most helpful things that we can do as creators and people that are discussing in this space. And you start the book by saying that we're now playing a new game with new rules. But of course, with a new game and new rules means that we have to come to the end of something. And you describe it as the end of the old order around about 2020. What was happening then?
Yeah, well, it may not have seemed like it, because if the media is always negative, right? Because that's what sells. And so it might not have felt like it, but the years if you were in a position to be investing from the financial crisis of 2008 onwards, it was a fantastic time to be investing, because you had interest rates at next to nothing. So you could borrow money really cheaply. Everything was going up. Inflation was under control. No one talked about inflation until a couple of years ago. When did you hear anyone talking about it in the queue at the shops or whatever? It didn't happen. And so you didn't have to worry about the effect that would have. And then in 2022, people tend to pin this on Liz Truss, but it wasn't her fault that this happened in the entire world at the same time. It's like interest rates went obviously inflation got out of control. Interest rate went back up to sort of like 5-ish% from zero. And 5-ish% is historically normal. But what's not normal is for it to go from 0 to 5 that quickly. And what's also not normal is to have this level of debt when you have interest rates at this kind of level. So it's governments, it's individuals, it's corporations. You've got this world that's awash with debt, which is something I talked about in my last book. But suddenly you're having to manage that in the context of far higher interest rates, which just means that the way we think about what's likely to work in the future and how investing is likely to perform in the future, what we should be investing in, it's just not the same as it has been from certainly like 2008 onwards. I think it was like this supercharged, but you can even track it all the way back to the early 70s. I think that trend that has been playing out ever since the 70s has suddenly reversed just like that. And that's why so much personal finance received wisdom may have been true for the last 30 plus years, but suddenly is not quite so true.
That's it. And I think it's acknowledging that when the macro environment has changed to that extent, yes, you can bemoan it. Yes, you can shake your head. Yes, you can hark back to the good old days, but that will not leave you in a position where you can have really the sort of agency that the kind of people that listen to your content, Rob, and certainly that have listened to my podcast over the last 4 or 5 years, they want an element of control over the direction of travel, and they want to have an element of sovereignty over where they might end up in the future. And that's probably, I think it's important to acknowledge that's become harder and that's become more outside of your control than previously, but there's still things that we can do, of course.
Absolutely. And I think I'm glad you picked up on the control point, because I think that's really what I try to have throughout this book, is just this sense of there's a view of the world, there's a way that things are put across where it's just like, if you just invest for long enough, if you just save, if you save your 10% and you put it into index funds and you wait long enough, then everything will be fine. And like, well, maybe it will, but I think it's going to be harder for that to be fine. But also, there, there's a certain type of people, certainly the type of people who listen to a podcast like this one, who will want more than that anyway. They'll aspire to more than just, wait 30, 40 years and you'll be able to retire. They'll want to either get there sooner, or they'll want to end up with a bigger, better result at the end. And I feel like that's often not captured in personal finance advice. It's often very much it's the basics. It's doing the sensible thing, and it's not acknowledging that you might want to be able to do more. So I think this is, without taking insane like entrepreneurial bets or whatever, you can go and by taking control, do better. And this is something that, whether you want to or not, like you've said, more and more people will be forced to do that because of the way the world is now.
That's it. Is that forced piece. And I'm a big fan of things like delayed gratification. I think it's been a big part in maybe some of the outward success that people will witness now on my Instagram or my social media. A lot of that's come from the quieter days beforehand when things were going on behind the scenes, whether that was with my brain, my body, my business, whatever. And that lends itself to the whole save culture, put a little bit away, do the basics right. And I think there's definitely a time and a place for that. But as you're saying there, it really has been stripped away to just do that now. And that's why I think your contribution to the space is important, because if you just do the basics, you are actually unlikely to get the result that your father, your grandfather, or even your big brother or big cousin was getting in this space.
Absolutely right, and I think all that advice is absolutely necessary, because all the you need to do the basics. Most people are not doing the basics out there in the world, and so that's why you need to hammer the basics. But there is this gap that I believe, like above it's either like do the basics or start a business. And starting a business can be fantastic, and I've done it; it's great. But there's a lot of people who are not going to want to do that, but they also aspire to more than just the basics, and so there is that gap there. And yeah, like you've said, and like I say in the book, like if you just do the average behaviors and you end up with the average result, for a long time the average result wasn't so bad, but the average is getting less appealing all the time. So more and more people are going to feel the need to try to overshoot the average, because the average is getting worse and worse.
That's right. And this time round, I was saying I really like the fact that you've split it into 7 myths. Last time round, I think we had 5 areas to cover in the price of money. That first one was all around the fact that the path to wealth begins with a healthy balance in your savings account. And that was a long conceived and long held premise that people should really focus on that. What do you see as the reality when it comes to savings now, Rob?
Saving is one of those where, obviously, if you don't save, you can't do anything else. If you're spending everything that comes in or more, then it's not going to end well. That's obvious. But I think the thing with saving is, for a start, uh, under the kind of inflationary conditions I think we're likely to continue having. Obviously, inflation is now back down from the double digits it was, but for reasons I go into in the book, I think it's going to remain a concern, and something that's going to be higher than we've become used to. So in those conditions, you could have inflation that's higher than the interest rate on your savings. So any cash that you've got in the bank is just going to keep melting away in the face of inflation, which has been, right now, as of today, is not the case, but that's unusual. It normally is. However, there's another problem, which I think is that, because I think saving has always been overemphasized, because yes, there has to be the first step, but it can be come across as like the only step, or it's just like save and then stick it in an index fund and be done with it. And I think that is the advice that you get, because again, most people aren't doing it, so they need to be told again and again. But also, it's the easy advice to give. Like, it will get a result for everyone. Whereas when you get more complicated than that, then obviously it's lots of subjectivity and like what type of person are you, what are your skills, all this kind of thing. All of that comes into it. So I just think that it's saving is overplayed, but out of all the things you can do, whether it's saving, earning, or investing, which are the 3 things I talk about in the book, saving is the least powerful of the 3. So it's necessary, but it's not sufficient, and it's the least powerful. So what I talk about is basically taking basic good practices and putting it on autopilot, and so it just happens, and then spending your mental energy on something else. So one of the things I talk about is not making a budget, which is like heresy in personal finance world. And again, acknowledging there are people who need to make a budget or enjoy budgeting and they find it helpful or whatever. But for a lot of people, it just sucks up what the limited part of your brain that most people have for thinking about this stuff. Whereas it'd be far better if you could take the equivalent amount of mental energy and dedicate it either to your investing or probably to your earning. You're going to get a far higher return on that time and mental investment than if you're constantly trying to optimize your savings.
Yeah, that's right. And again, it's one of those ones that kind of flies in the face of what's been heard before. But when you, as you say, when that's on autopilot, we're big enough, clever enough, and ugly enough to spend some of that mental bandwidth on finding things that may have that more aggressive potential return. And I have my kind of aversion to stock picking, but I also am now more aware of maybe asset picking or being more
Mhm.
open to having a different makeup within my portfolio than purely being in two or three ETFs or even just one ETF like the S&P 500 or a global world tracker or the FTSE 250, whatever you pick your poison. I think that was the kind of prescribed advice. And I think, as you say, for the vast majority of people, depending on their timescales, they're probably going to end up somewhere in the ballpark, but it's not as guaranteed as it was previously. So we have to maybe consider, and Andrew Craig spoke about this the last time I had him on the pod for the third time. He was like, we need to stop being so passive. And I think it's similar to
Mm.
what you were saying there. It cannot just be passive, 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 passive. There has to be an element of, right, turn my brain on. Is this a trend that I maybe want to have exposure to? Is this an asset class I want to have exposure to? Is this a type of company or an industry that I want to have exposure to? And I think that is the sort of nudge in the right direction that some people need.
Completely agree, and I agree with Andrew on almost everything. He's great, but the yeah, whether it's but being active doesn't have to mean stock picking. It can mean asset picking, like you've said, or it can just mean actively focusing on your career, your business, your earnings, whatever. But it means actively doing something, and just you this part of your life, like the money isn't everything, but money makes everything else a hell of a lot easier, and so it needs some degree of your time and focus. And so I think, but acknowledging that everyone has limited time, everyone has other things they'd rather be doing, other things that they have to do. And so if you've only got so much time and focus to give it, you need to make sure that that's going where you're going to get the most bang for your buck.
Yeah, that's right. And again, it is a little bit of a hard pill to swallow because there are times where these passive investments have a really good ROI and their track record's pretty strong. I guess it's just understanding that the macro factors mean that that's not perhaps going to be the case in the same way. So, for example, I've been pretty fortunate with the S&P 500 over the last 3 or 4 years in terms of what that's looked like, but that's not like it's not guaranteed. I mean, I'm pretty bullish about America under Trump compared to under Harris or Biden previously, but I don't think it's guaranteed that America is going to be the world's leading superpower and the 500 biggest companies in there are going to all fly as they maybe have done in the past.
No, I mean, that sort of takes us on to a different myth, but I think it's worth mentioning now because I think the fact that people will say that the S&P is up by 20 something percent over the last 12 months, but that shouldn't excite you. That should scare you because the higher something is, the more likely it is to crash. The valuation levels are so stretched. The biggest companies that are driving that market, like you think you're diversified, like what percentage of your even if you're in a global tracker, about 65% of that plus is the US. And of the US, what proportion of that, I can't remember the figure off the top of my head, but it's a big one, is basically five companies which are all trading at massive valuations. So I think people tend to look in the again oversimplify the stock market side of things and just look at it over far too short a period of time. And just because something's gone up recently does not mean it's going to do that every year. It doesn't mean it's going to, just because it's averaged 10% a year over the last 100 years, which it has, which is incredible. That does not mean you can put 10% into your calculator and assume that's going to be your compound return forever, because it's not.
Yeah, completely agree. And it's just an awareness piece of that past performance is not always an indicator of future performance. While equally, history doesn't repeat; it sometimes rhymes. There's still more considerations to do, and I think the kind of person that's going to read your book, that's going to listen to several personal finance episodes that I've released over the last couple of years, they're going to be nodding along and thinking, "Okay, I appreciate your advice here and understand that if I can get my good habits on autopilot, then I should be opening up my mind and my energy to maybe think about what else can I experiment with or give myself exposure to.
For sure. And I think that one of the big problems with trends is that they can play out for such a long time that you forget that there's even another way. And it's just when you kind of forget that there is another way that everyone gets surprised and it completely changes. It's the same in the same way that the US has dominated the world for as long as anyone can remember. It's not going to happen forever, but it's almost hard to imagine it not happening forever. But history tells us that you don't get the same global superpower leading the way for century after century after century. And it's the same with the trend that we had in interest rates, which was from the 80s onwards for 40 years. Interest rates were just falling down to literally nothing and negative in the Eurozone. So it's like, surely that's going to carry on forever. Just as you think it's going to carry on forever, it suddenly changes. That's the problem.
I think that was the frightening part. And I listened back to our episode that we did today in preparation for this, and you and I were both talking about fixing into particular mortgages in 2022 because we were able to forecast what we were able to pay for as long as physically possible. Whereas culture prior to then was actually just to maybe take a 1 year fixed or a 2 year fixed or a 3 year fixed because you could maybe shop around and shave a few percentage points. Whereas best practice, if we looked at over a 30-year period, was if you're happy with 2%, if you're happy with 3%, even if you're happy with 5 or 6%, lock in because
Look at it.
you know that you can pay that. Like if it goes to 7% at the drop of a hat or 8% at the drop of a hat, you haven't budgeted for that. Whereas if you budgeted for 5% for the next 5 years, at least you know that figure. And I think that's something that like I really like in my life, certainty. And it's funny that we were almost like weaned off that level of certainty and thought like encouraged to be like consumers and to shop around with these rates prior. But I think the longer term picture will be that we see interest rates become far more fluid than they have been.
Yeah, and there's always, at some point, there will be another crisis, and to try to get out of that crisis, rates will be cut down to next to nothing again, and money will be printed, and all the rest of it. But it's far more the risk of rates going up is far more damaging than the missed opportunity of rates going down. So I'd definitely rather have the certainty than try to get too clever. Because if macro tells us anything, it's impossible to forecast this stuff. Everybody who tries ends up looking stupid, and so it's just like you can't try and be too clever with this stuff.
Yeah, agreed. And your second myth, Rob, was that if you work hard enough today, retirement will be your reward. Why is that a myth?
Well, this is probably the most depressing chapter of the book. They're basically saying that the whole notion of retirement, when you actually start looking into it, is extremely recent. So, like, retirement as a concept didn't in terms of like the states paying you a pension from a certain age onwards, didn't exist anywhere in the world until I think 1908 or so, maybe a little bit earlier. Didn't exist in the US and the UK until even later than that. But then, of course, the pension age has gone up periodically, and everyone gets very upset whenever it does. But lifespans have gone up by far more, and we've now ended up with a situation where you can get if a woman in the UK, if she dies at the most common age for a woman to die in the UK, because they live longer than men, could spend a third of her life in retirement, and that's bonkers. Like, obviously, when you start to sort of like map out the dependency ratios of how many workers to retirees and everything else, you go, well, this is completely unsustainable. And the fact that retirement as we know it today will be looked back on as an aberration. And that's a scary thing. But also, when you think about it on a personal level, the argument that I make is, do you really want to spend a third of your life being not, I'm not going to say doing nothing, but let's just say not
Lacking
striving or
purpose, yeah, like almost removing that
yeah,
level of oomph to your life.
yeah. And I think obviously this is very open to critique by going like, yeah, there's more to life than work and blah blah blah. Yeah, of course there is, and there are plenty of ways of finding meaning and adding value beyond paid work. But if you reframe paid work and look at it as you get paid for adding value to the world and doing things that people are willing to pay you for, and then normally when you're able to do something that adds value, that's something that you enjoy, you get satisfaction from. So again, it's not the only way of getting satisfaction, adding value to the world. So it's not something you're not going to be wanting to work 50-hour weeks until the day you die, and you might not physically be able to or mentally be able to anyway. But I think I map out and paint the picture of a view of the world where there's not this cutoff where like work as hard as you can, stop. And if you can develop ahead of time a way of generating income based on the value you can add that allows you to be more flexible and sort of like ramp it down, maybe, and ramp it up again for a bit and just have that flexibility, then it's something that can be part of your life alongside leisure, alongside family, alongside everything else for a far longer period of time, which is not just more satisfying potentially, but also, of course, it takes all the pressure off this situation that everyone's in, where it's just like, well, I've got this fixed amount of time to accumulate this huge pile of money that then needs to support me for an unknown amount of time. And you end up doing these calculations where, well, I need to be dead by 81 or I'm going to run out of money, which is not a position you want to be in.
Yeah, you're completely correct, and I think when people speak about these things, it is intimidating because one, people don't want to think about the mortality. Two, people don't want to think about the potential situation of being destitute, and so many times they're like a lot of the things that I think are maybe potentially a helpful joke start for people are the fact that you should have X, Y, or Z by the age of 50, 60, 70, whatever it is, in order to support you in your retirement. But as you say, life expectancy is expanding. We spoke about Andrew Craig already. The future is biotech. His latest book was speaking all about increasing life expectancy, potentially beyond 100 for a lot of people as well. So life is going to continue to expand. So that third of your life spent in quote unquote retirement may actually be getting bigger and bigger for many people.
Mm.
And I mean, I've been really fortunate to speak to an entrepreneur who sold out his business in the US. And one of the phrases he uses really stuck with me. But when he sold out his business, he was told, beware every day is Saturday syndrome. And that is the exact same for an entrepreneur exiting, and it's the exact same for somebody who's worked and grafted in a corporate career, and then the button goes poof, and they go, right, that's me retired now. You can't just go and play golf all the time. You can't just go
Mm-hmm.
to the leisure club. You can't just go to the whatever it is. That's not really how people who are wired to work hard and push themselves can flick that switch in the same way. And I think we're speaking to a
Mm.
demographic that, of course, will probably look forward to some leisure time and winding down, maybe spending more time with family. But I think the concept that you speak about, where having a way that you can earn almost indefinitely that's relatively satisfying, is something that's far more meaningful to aim towards, because as you say, you can dial it up and dial it down. So for example, I think you give an example of a guy in the book that was a consultant, and he was like, right, I'm going to summer in Greece this year, so I dialed down how much work I'm doing. But guess what? During the winter months, when it's a bit crap in the UK, I'm just going to graft a lot more, and I'm going to work 4 or 5 days rather than 3, 4 days, whatever it was he was doing previously. And I think that's a helpful thing to think about, albeit a shock to the existing system and a shock to our kind of existing parameters.
Yeah, totally. And this will sound completely alien to anyone who is working really hard in a job that they don't get any satisfaction from, which describes a lot of people. And so to be told, great news, you can work for even longer. It's just that, and even the idea of getting any satisfaction from it might be completely alien. And I'm not denying that. Like to be in a position where you enjoy what you do and have that flexibility is a privilege that many people won't have, but it's something that you can, because of that, it's something you need to start working towards. And one of the points I really hit on in this chapter is about taking control of your career. I think too many people see their career as something that happens to them, whereas if you completely reframe that and take ownership of it, then yeah, you're not going to be able to turn it around overnight, but over time you can get yourself over a 5-10 year time period into this kind of situation that we're talking about. But it's not just going to happen for you. And it does ultimately come down to breaking the connection between time and money. And so in the book, I talk about like a 3-step process of, like, first of all, embracing the connection, making the most of your career, taking ownership of it, then weakening the connection, loosening it, which can be a kind of consulting arrangement. And maybe you stay there. Maybe you eventually get to the point of breaking the connection and you have something that you created once and you can just it just sells itself forever. You don't have to get to that third stage, but if you can, then that's a pretty good place to be.
That connection between time and money was one of my favorite parts of the book, and the highlighter was out at that point. I was scoring all over because I was thinking, as you wrote, the amount of money you earn is made up of the value you provide multiplied by the number of people you provide it to. And I think anyone that's paid attention during this online money, internet money stage has seen people do that with the audience they've built and the product they've sold to that audience, or the audience they've built and the sponsorship deals that they promoted to that audience as an affiliate. There's really clear, easy ways to see it demonstrated. But when you maybe give examples of consulting, I found that really interesting as well, because I've been offered a number of roles on a sales consultancy basis. So doing a day a month or a day a week or a day of every quarter in a business on a sales perspective, it's bringing my value as somebody that can sell or teach people within their organization to sell in a similar fashion to me. But it's done on a much smaller basis than like a 40-hour per week contract that typically an employer would want for some sort of BD or sales director or sales role. So I was nodding along and thinking, okay, that makes total sense. If your value is able to be applied in a shorter time setting, then you can charge in line with that. And that, of course, starts to break that connection between I work 40 hours a week for X company or Y company.
Yeah, exactly. There's an example I give in the book, which is very similar to the situation that you've described with yourself, which is that if you've got the ability to produce the result, it doesn't have to be you producing the result. Sorry, you picking up any background noise here? My kids are going bananas.
A tiny bit, Rob, but don't worry, let's keep going.
Okay. So you've got the if you've got the ability to produce the result yourself, then you don't have. If you can get to a position where you can deliver that same result without it being you physically there doing the thing yourself all the time, then that can be you going in for a day a week. It can be you putting a product together that are training people that allows them to get their result on their own. But it's all about it's the result that's the thing that's got the value, and the delivery mechanism of that result can change over time.
Yeah, and it's really challenging to think about. But again, it's one of the ones I actually think is quite empowering and encouraging, because if you can start to develop something that's really valuable to your existing employer, it's probably also valuable to other employers in your space. But of course, you can't go and work for them all. Although one of the things that you're talking about in the book was people that had multiple jobs because they realized that they could get their existing workflow done in far less than their contracted hours. So they were picking up 2, 3, I think some of them had 4 or 5, like crazy number of jobs. And they were just able to do their exact number of deliverables, no more, and just collect their paycheck. And I think that's something that when you gain a level of mastery in whatever your level of employment is, and perhaps you've got more homework or remote work, that is something that's also possible for people, albeit a little bit unpalatable for some people to think about, particularly if they're an employer of a lot of staff.
Yeah, exactly. I don't know if the multiple jobs thing is something I'd necessarily condone or want to aspire to, but it's an example of switching your brain on and finding a way to maximize your situation. And there's other ways of doing that. It's like if you're going like, okay, well, this is what I'm doing in my current role. How do I learn a new skill that will combine with the skill I've already got, that will give it value beyond what I'm doing now, that will allow me to either earn more where I am now, or go and get a better job somewhere else, or be that missing link to being able to do it as a consultant. There's all different ways of doing it, but it's not just going to happen for you. Like the default, if you're just kind of doing the thing and you just hope you get your pay rise every year, you hope your boss keeps you around or whatever, no one's going to say to you, hang on a minute, if you just did this, you could charge 3 times as much money. No one's going to suggest it to you. So there are millions of different paths, which is why I think most books focus on just like, well, save a bit more because it's easy. Anyone can apply that. This is like, it's hard to be prescriptive about, but I think by taking some of the principles that we've spoken about, anyone can find their own way of applying that.
Yeah, I totally agree. And again, like one of the big things for me that I was nodding along with, and it was the theme almost throughout a lot of the different myths, was the responsibility on you to earn more. Because one of the things that I spoke about with Nick Magili a couple of years ago, I really enjoyed his book, Just Keep Buying. But he was talking about if you can put £500 into the market on a monthly basis, that's £6,000 across the year. Okay, fantastic. 10% on that is 600 quid. If you did a couple of shifts at your friend's bar and a few weekends across the year, you're going to earn 600 quid. So you really need to think about, how do I generate more money so that the £6,000 that I'm putting into the market becomes £10,000, becomes £12,000, becomes maxing out your ISA with 20 grand, becomes maxing out your ISA and maybe doing a buy-to-let property, or doing a bit of crypto, or doing some whiskey, or doing some wine, or whatever it is. And I think that's something that is sits alongside a lot of your advice, where people need to recognize that there's a responsibility to really change the game is to put more and more and more, and the only really way to do that is to generate more from your side.
Yeah, it's an uncomfortable message, I think, because I don't know why people seem to struggle with the concept. Whereas, like, obviously, earning more from your investments, yeah, if I'm going to be a better investor, of course, I want to do that. Even saving more is like people can get their heads around that, but people feel uncomfortable with the emphasis on earning, but it really is the ultimate silver bullet, because like earning more is like there's only so much you can save. You can't cut down to zero. You can't force your diversified collection of investments to be any better than it is, but you can earn a, in theory, infinite extra amount. So of course that's where you should be focusing, and it just doesn't get much attention. And like I think Just Keep Buying is a really good book, and I think his work is fantastic, but I had that exact same issue with it, which is that you've talked about saving, you've talked about investing, you've completely missed the biggest lever that you can possibly pull to change your finances. And if you've got the ability to earn more in future, then it means you don't have to worry about your savings rate or whatever today, because like maybe you're only saving 5%, that's the best you can do, and everyone will say you should be saving at least 10. And that's you. So you might think, well, the solution to that is to spend all my focus on cutting back further to get to the 10%. It's like, no, because if you can earn more, even if you don't have to invest all your extra earnings. Even if you just invest half of it, you can have lifestyle inflation. You can be spending more, but you can also be saving more, and your savings rate automatically goes up. So if you haven't maxed out your earning potential, then that's always going to be the most powerful lever. And it means you don't have to go absolutely bonkers trying to like you don't have to be at the finishing line when it comes to how much you're saving or investing or whatever today, because you can get there in the future.
There's only so far frugality can take you.
Yeah.
It's not a never ending ability to just cut back and cut back and cut back. Third myth that
No,
I had.
and there's a book called Die with Zero that I'm sure you're familiar with, right? Because that really influenced me in terms of some of my personal choices. But I sort of thought about it a lot when writing this part of the book as well, because it's like if you do go down the frugality path, then you end up in the years when you could be having all these peak experiences and the only chance to do certain things, you're kind of wasting them. So I'm trying to make all these tiny little cutbacks that aren't going to make as much difference as if you focused in a different area.
That's so right. Because one of the pieces of advice you gave on our last episode was around saving, was like, is what I'm spending worth what I'm getting? So, for example, yes, you could cut your David Lloyd membership at £100 a month to one at JD Gym for £40 a month, but is the difference in experience and network and quality of gym worth it for you to pay an extra £60 a month? Yes or no? Now, it may be no for many people, it may be yes for other people. Is the Waitrose food shop that you get commensurate with the value that you pay extra from the Aldi or the Lidl that you've got next door to that? Some people would say, "Oh, well, straight away I can swap to the Aldi," and that's great. But people have to make a choice based on that. So I think Dive Zero was quite a helpful way to do that on a macro scale in terms of,
Mm.
are these experiences, or these holidays, or these ventures, or these things that you really feel like you want to do worth it, or are you better to, and it sounds really rude, but like scrimp and save in order to enable what it is that you need. And some people will have massive spending issues, Rob, and be completely out of control, and they need to be on the other side of that. But many people that are thinking about this on a deeper level probably are on that other side.
Yeah, totally, and that's why you're doing. And I, in the book, have to kind of caveat it to death, because you can easily pick holes in it and go, what if? Well, I think people who are watching or listening to this are probably the kind of people who get where we're coming from with this.
Yeah, agreed. And that third myth that you had was the correct way to invest involves reducing risk as much as possible. And what I really like on how you said it out was talking about the reality of that being that there's actually no correct way to invest now. And I guess that's because of the macro factors that we've spoken about. But there is a need now to ignore the traditional models that have come before, because a lot of the associated wisdom of that kind of 60-40 split between stocks and bonds is really, really outdated. Even from doing the podcast since 2020, I had people on speaking about Andrew Craig's rule, 100 minus your age, in terms of like conservative versus aggressive assets. I had Pete Matthew talking about bonds being potentially a better option and when interest rates have changed, but that actually hasn't been the reality, which I think is bonkers. So a lot of conceived logic that's come before and a lot of risk light options have actually not performed at all well in the recent past.
No, and 2022 again was the year when just like everything was performed like the complete opposite of what it should have done, and if your diversified portfolio fell by far more than your like all out stocks portfolio would have done. We should and maybe that is a complete one-off, and aberrations do happen, but I think I think a lot of that has shifted. But even if that's not the case, the point that I make in this particular myth is that all that it's all a bit oversimplified anyway, in that like they're like even if you could work out an optimal way to invest, which is arguable, about like there is arguably a mathematical way of figuring this stuff out, which some people have won Nobel Prizes for. But even if you could, the argument I make is that it completely ignores one of the three motivations that we all have when it comes to our money. So I've taken this from a very little known piece of work that should be better known by someone called Ashvin Chabra, which identifies that people, whenever anyone's making decisions about what to do with their money, they're thinking about protecting what they've got. They're thinking about maintaining their lifestyle in the future, even when they ease off on work. But they're also thinking about improvement and how do they make a leap upwards from where they are now. And all this kind of optimal stuff about you see when you model it all out completely ignores this third motivation. No one will talk to you about how you take big swings and potentially end up way wealthier than you are, because it's really hard to give template boilerplate advice about it. You can't go and back test and go, oh yeah, just use this model. It is hard, but by ignoring that motivation, it means you end up unhappy because everyone has to a greater or lesser extent all three of these motivations. So you can't just ignore one of them because it's inconvenient.
That was one of my most novel insights from the book, about acknowledging that people have these three different motivations, because there may be people that consume a lot of this content that are very much in that maintenance mode. There may be people who are very much in that protective mode and are quite adverse to potential risk. And then, of course, there is the large group of people who are like, look, I want to change my life through these investments. And I think that's where a lot of the crypto bros fall into, in terms of some of the guys that I've interviewed on the podcast that have really changed the dial in terms of like their wealth and their lifestyle in a very short period of time. And because of how public that's been for a lot of people seeing that, I think more people are maybe moving into that camp where they do think they can pick a meme stock, or they can pick a coin, and things can just go poof. Whereas there's other people that are like, oh no, well actually I'm doing quite well fiscally. I see myself working this career for 30, 40 years. And if I can get 10 to 15% on the S&P, I can pick up a few buy-to-let properties, I'm going to be in a great position. But it doesn't account for everyone, does it? And I think having an understanding that there's three competing motivations is valuable.
Yeah, and it's easy to make fun of all the crypto bros who like lost loads of money on meme coins or NFTs or whatever, and like go that that's completely irrational behavior. And in some cases, sure, but in some cases, it's maybe not so irrational, because if you look at the path that you're the average, you look at the average path, what you get if you kind of start where you are and you follow the advice you're given, and that doesn't look very appealing, then even like trying to take the big swing, and even if there's a chance, even there's a significant chance that it won't work out, it's still rational to take to that person to take the chance, because their improved drive is super strong and it outweighs the two others. That's an extreme version of that, and most other people will be wanting to balance these three motivations more carefully. But it just makes that point that everyone's starting from somewhere different and is aiming for a different thing and has a different attitude to risk versus reward.
What I wrote down as your sort of formula to potentially balance that was a cash emergency fund to tick that protection box. And I was nodding along. That's good financial advice, I think, albeit I'm sure you're not giving direct financial advice. Crypto was like a speculative improvement area. And that was, again, something I was like, I can completely see that. And I can see that from my own crypto portfolio. It's been a way to significantly increase the returns that I would expect from a typical investment. And then last but not least was actually that maintain box was actually achieved by the whole diversified approach to the stock market. And again, what I love about your work, Rob, is that's so incredibly actionable. And you can visibly see how that achieves each of those different motivations, because I think you could introduce a concept like this and say there's three competing motivations, and then not give an example of how on earth to maybe cater to those three different areas. And I think it leaves people in that kind of limbo thinking. And while those three might not be perfect for everyone, I think most people should acknowledge having exposure to crypto is prospectively got an upside to it. Having a cash and emergency fund is pretty fucking essential for protecting your lifestyle. And then, of course, that kind of maintenance mode is something that a lot of conservative listeners or people who just are not in so much of a rush are they're gonna like, it's gonna tick a box in their brain for them.
Yeah, for sure. And that it's the speculative bit, which is why you need to keep your brain power and not waste it on like, oh, should I have a latte or not? It's because it's like whenever you are making the bets that are more likely to, if they pay off, make a significant difference, then you need to be going into that intelligently, because you can be like taking a calculated risk, or you can be gambling, and you need to be doing the former and not the latter. So you're not just going to luck your way into something that is going to have this enormous payoff. But so that's why you need to be save the energy that you put in should be going into either earning more, because that's a pretty much guaranteed payoff. If you take an intelligent approach to your career and work hard and all the rest of it, you will make more money. Or you need to be putting your attention into these investments where they can pay off if you pick the right one and you go about it in the right way.
And I really like that you acknowledge that there's time that needs to go into that, because those are the ones that have the risk that if you don't really do your due diligence, and even when you do, there is still a potential for you to be burnt or left high and dry. And I know that from sitting in losses on a couple of coins since 2021. And it's only really now that I'm seeing the kind of percentage returns that are way beyond what I get in the stock market. And I'm thinking, okay, well, because I've been patient across the time and I didn't need access to that capital, I've been able to benefit from the potential speculative returns that I took because I was comfortable with the use case of the coin. I was comfortable with the timelines that were involved because I knew we were going to come into a bull market at some point. I just had to wait. But if I hadn't had the time and the energy to research that and make sure that my mindset and my understanding of it was correct, then I would have been probably one of the ones that was shaken out as a weak hand from the market.
Yeah, exactly. So because you'd put the work in, you had conviction in why you'd invested in it in the first place, and you'd sized your motivations accordingly. So you didn't need to sell out because you didn't have your emergency fund. So the minute your car breaks down, you have to sell out. And so that's why getting the balance between the three is so important. So you don't want to be going out into all out risk mode and putting everything in jeopardy. But when you are, you're still taking a risk. The range of outcomes is bigger. It can pay off really big, but you can lose big. But you're less likely to lose big if you've put the work in, and you're not like putting your back to the wall where it's like, this has to work or I'm screwed.
Absolutely. Myth number 4, you should always aim to buy your own home. Rising prices will make you rich, and renting is throwing away money. Now, I know from a personal perspective, Rob, you've probably been in so many arguments in the property world about this. Why is that a myth?
Uh, it's a great one to get engagement about because everyone gets very upset about this. So I try to not get too involved because it's tiring and people won't change their minds about it. But the point I'm making is, I'm not saying that owning a home is a bad idea, but I'm saying that it should at least be a decision. It should be a choice to make. It shouldn't be like the default is you have to own your home, otherwise your life is over. You can't possibly succeed financially. So if you already own a home, I'm not saying you've done anything wrong. You haven't. But if you're in your 20s or your 30s and you don't own a home yet, then that doesn't mean you should necessarily feel bad, because what people seem to think that property is this magical thing where it just performs better than any other asset and prices only ever go up, and that's not true. You do get a benefit of being able to use leverage. So you, by using a mortgage, if the property market goes up by 2%, your investment might go up by 8%, which is fantastic. And so if that happens to you, the value of your home, amazing, the value of your home's gone up. But to a degree, so what? Because while you're living there, it makes no difference to you whatsoever. And this is why I sort of say that your home is actually part of your protect bucket. Because even if you buy a home and it's £100,000 and it ends up being worth £1,000,000, it makes no difference to your lifestyle whatsoever unless you downsize or you move to a cheaper area, which of course you can do, but most people don't. And even if you do, it's like you only get the benefit of your investment if you completely uproot your life, which is like the worst kind of investment, really. But property itself is not a magical thing. If you took the same amount of money and you put it into any other asset, including property, including investment property, which is what I do, then you can end up in as the same position or even a better position. So you need to have assets, but you don't have to live in your assets. That's the point that I make. And so if you know that there's a home, you want to live there for 10 plus years, you're very settled, great. It may well make sense to you. But if you're in your mid 20s and it would involve taking all your money and then some, and even then in 3 years you might get an opportunity to move for work, or you might meet someone and want to move in with them and start a family, so you need to move, then it might just not be the right thing to do. And it doesn't mean that you're absolutely doomed financially until you buy a house.
I think it's becoming harder and harder for early, mid 20s, and even early 30s people to buy their property. So it's helpful to think about that. I think there's a great degree of, it's a skill to be able to save a deposit. And I really recognize that, because I think that's something that's missing from a lot of people. And that's a really like unfair thing to say for some people, but it's something I've noticed among some of my peer group and my age group. But if you were able to save that money and invest that money in separate asset classes, as you're talking about, or investment property as well, and there's some tax benefits to not necessarily living in your investment as well, as you were saying, I think that's a really interesting thing for people to start to consider. And it's not the be all and the end all to own their property. Although, I'll speak from experience. My brother and I getting the property we got at the price we got, we're very pleased with. We've lived in it for 5 years now. There's no immediate plans to move out of it. If we were to sell it, we can make a pretty notable profit, and that would allow us to go again both separately or together. So there are circumstances where it makes total sense, but it's not the case for everyone to just jump on the property ladder at the first sign they get in like a new build property that's churned out 10 a penny in an area that's got a massive supply of housing. Like it's not the path that we all need to go down.
No, it is the right path for lots of people, like you've said, but it's just a bit. It shouldn't just be an absolute, like, it's not even a thing to think about. It is something that you should think about and not feel bad if it's something that's not available to you right now, or if it just doesn't feel like it's the right thing, but everyone's telling you that you have to. There's so many cultural forces almost shaming you into being a renter, and there are lots of I rent, so I know there are lots of drawbacks to renting, but it's not something you have to do. The reason you tend to see people have done very well with property over time, I think, is two things, neither of which are actually exclusive to property. One is leverage, using a mortgage, and so you can do that with investment property rather than your own home. And the other is that it forces you to save. It forces you to be paying down some of your debt, but also like your some of your payment every month that you're making on your mortgage, some of it is the interest and some of it is basically savings. It's like it's if you weren't paying that towards your mortgage, you could be putting it into the stock market or whatever. But because you have to do it, you get your house taken off you, you're highly motivated to do it. But if you could have those same habits and get the same benefit of leverage potentially by investing in something else, putting tax aside and other stuff, you'd end up in the same place.
Such a good point. Such a good point. Let's move on to myth number 5, and that's compounding returns are the eighth wonder of the world. They will turn even small investments into serious wealth. And I guess we spoke a little bit around that when we are talking about Nick Majouli's Just Keep Buying and the whole £500-600 a month. Like, we really do need to push that amount up. Whereas that whole like small returns can turn into serious wealth. Yes, but it's going to take a fucking long time for that to happen.
Yeah, my beef with compounding is that, like, when you look at people say, like, you put in this much today and in 50 years you'll have this much, and it's like, wow, yeah, incredible. But if you actually look at the curve and you work out how long it takes for the returns on returns, the actual compounding bit, to start kicking off, you're looking at least 20 years, really more like 30, before it becomes anything meaningful. So it's like, again, it's not saying don't do it, but what I'm saying is don't put too much focus on that area, because it's going to take a really, really long time for it to come good. And so if you're sort of coming into this and starting to think about money for the first time in your 40s or 50s, it's not going to be a massive amount of good to you, because it's going to take possibly longer than you'd want it to, longer than you've got, for it to really start paying off. And so you're going to need to do something else. But even if you're in your 20s, which is the prime time to start taking advantage of this, it's like, well, yes, take advantage of it. Like if you can be saving into a pension, especially if you've got an employer who'll contribute to your pension, all this, if you fill your ISA, whatever, do that, because in 30 plus years, it really will start to become something exciting. But don't spend all your time trying to figure out like with it whether you should be in ETF A or ETF B, and like is the fee very slightly lower on this one and whatever, because it doesn't actually make any difference. That's not what's going to make the difference. What's going to make the difference, going back to the same theme, is earning more or making these improved style investments where you can actually use your time and skill to get the outcome. So I think the problem with compounding is not that it doesn't work. It does work, but it just takes forever, and people overemphasize, again, put too much time and focus onto it, when really it's another of those, just automate it, just get it happening, forget about it, move on.
Assign as little energy as possible to it. And I think you're totally right. And it's the law of large numbers again, isn't it? It's that whole, if I can increase the amount that I'm putting into the market, then the compounding will happen closer to the 20 years than the 30 years. It maybe happen in 10 years if you're really starting to earn a packet and you're starting to pack it away. That's when things start to move an awful lot faster. Like really silly stuff. Like I'm sure in your space, there's fixed percentage returns on property investments. Now I've done one before for like however much it was, and I got back a particular figure, and I was thinking, well, if I did 6 figures, then I'm going to get back 10 grand rather than 3 grand or 4 grand or whatever it is when you put in 30 or 40 grand. And that takes time to have that available capital to do that. But that's when compounding starts to have a bit of an effect, because if you do a couple of those deals a year, you're going to start to see significant growth in your portfolio. And I guess it's just when you start to see those numbers talked about from people that I know and can look and talk to, I'm like, right, I really get this way more.
Yeah, absolutely. It's one of those things where, yeah, I think if you are going to be putting, you start to see the benefit after such a long time, unless you're doing something particularly clever. So you're using your own network or skills or whatever it is to get access to bigger opportunities. If you're like anyone else, then the difference that you can make by just buying like mainstream financial products, it's going to be negligible. And it's really it pays off over such a long period of time. But everyone looks to Warren Buffett for this, because it's like the example of like, he made 90% of his wealth after the age of 60 or whatever it is. But that's because he's like 98 or something now. So like, you really want to be taking your vitamins. That's the best thing you could, like, getting down the gym is the best thing that you can do for your future compounding, because you need to live long enough. And then by the time he's been compounding for 40 years since he hit like retirement age, right? So then it's like, it gets absolutely insane. But the thing that you need to do to make that happen is not do something phenomenally clever now, is just to get it started. And then once you've got it started, just let time pass and be around for long enough to enjoy that. That's what makes the difference. It's the passing of time. It's like you can make big money quickly with other things, whether it's with business or with something else. But with this kind of mainstream, call it like your index fund part of your portfolio, again, set it up, make it happen, leave it alone.
Totally agreed, Rob. Myth number 6, diversifying between stocks and bonds is the way to stay safe. And I suppose we've already talked a little bit on bonds there, but talk to me a bit more about that diversification piece.
Yeah, diversification is it's a tricky one, because it's something that a lot of people think about a lot, really struggle to know what they should be doing. The argument that I make is, because of some of the things we've already spoken about and what's happened with bonds, what happened in 2022 when like everything went completely backwards, because of all that, because of inflation, because of the volatility that we're seeing in bonds, that kind of stocks bonds portfolio is less safe than it seems. And so it really comes down to what you want and what your time scale is, because it is rational in some cases to just like give up on diversification completely and just do, if like there's a very high probability that stocks are going to outperform everything, bonds are going to outperform cash, going to outperform gold, going to outperform whatever. So just go all in on that, because if your time horizon is long enough and you've got the ability to ride out the dips, and the dips can be massive, then that can be the right thing to do. But if you actually want diversification, you truly want diversification, then the what you have to do to get that is going to be broader than stocks and bonds. And so I talk about lots of different ways of adding diversification in, different ways of combining it. But I talk about crypto, I talk about gold, and talk about property, all these different things that you can use to get true diversification. And this is something that I do attempt to do, even because even if it might be rational for someone in my position to take to sort of to weight it more towards stocks and just deal with the dips as they come. I don't really want to. I want this to be part of my life that I just don't really think about, and so I do go for more what I call true diversification, because it means I can just relax, and maybe the return is a tiny bit lower on an annualized basis when you come to work it all out in the end. But no one knows. So I'd just rather take the relaxed approach. That's not going to be the right approach for everyone. But the point is to not buy into the myth that just by doing this whole stocks bonds thing, you are somehow safe, because I don't think that's likely to be the case.
Yeah, it's not the case nowadays. When did you realize that you were more comfortable with the relaxed approach?
It was really only within the last couple of years, because I spent because the what I came to realize is I've got my business, and I've got other things that I'm actively involved in that's really going to make the serious money if things all pan out. And it's that's and I'm doing things that are earning money for me at the moment, and that's what really matters. And so I but then I was spending a reasonable amount of time like really trying to like optimize this whole balance of different things, and and doing a bit of everything else. So it's like it's just stressing me out. It's just another thing to do, and it's just not making that much difference. I really asked myself, like, how would I feel if the stock market did crash by 50%? Because occasionally it does, and I realized that I'd be far happier to have like you're still going to get a big drop. Like if stock market crashes 50%, the world is in trouble and everything's going to drop. But I'd far rather have a 20% drawdown than a 50% drawdown, and just like not have to think about it. And so that's where I eventually ended up. But it was a whole process of doing the wrong thing in lots of ways before I kind of realized what was the right thing for me.
That's true. Quite often we have to see what we don't want to understand what we do want. And maybe sometimes experience what we don't want to say, okay, I don't want that to happen again. I'm going to move away from that. Like I've got a really good friend who has absolutely no tolerance for the movements in crypto, but has the capital to come in and make huge wins and gains. He did it once and he's like, I'm never doing that again, because when it was red, it was all I looked at all day, every day.
Mm.
And I was like, okay, well, that sounds like a real waste of time and energy if you're looking at that all day, every day, because you've got nothing you can do to affect it at all. So it's
Yeah.
recognizing how you're wired and whether you have the tolerance for the dips, the red days, or the mental bandwidth that you have to assign towards that. And as we've discussed throughout this episode, having the mental bandwidth assigned to things that really, truly matter and can change things are far more important than maybe you spending time on Robinhood or Swissborg or whatever app you're using to look at your portfolio.
Yeah, exactly right. And if you diversify enough and you've got crypto as, I don't know, 5-10% of your portfolio, whatever it ends up being, then it's in the realms of don't have to think about it, because it's part of the overall picture. One thing's doing well, that means another will be doing badly, and so it's just not something you have to concern about. But if you are deliberately taking a more concentrated position because you want to get the bigger win, then you have to be like mentally okay with the fact that you're going to have the volatility is something you're going to have to deal with. And are you okay with that or not?
True. The last myth is a little bit around risk as well, and it's ventures like stock picking and starting a business are insanely risky. Most people should stay away. Why is that a myth nowadays, Rob?
It's because it's getting at this whole drive for improvement that we've spoken about. It's like if you're not going to beat the market by investing in market investments. It's like you but you can beat the market by stock picking in the right way, something in an area where it's based on your own knowledge and time and skill, not just taking a punt by something that someone else recommended on a podcast or in a group chat or whatever. You can get there by investing in property. You can get there by starting a business. You can make above market returns by doing all these things. But for all of them, their range of outcomes is bigger. It's possible to lose far bigger, and it all involves your time and skill. So you absolutely can do it, It's just like, are you willing to do it? But as we've talked about, I think more people are going to be driven towards doing those things because, like I said, the average is getting less appealing. So wanting to beat the average is something that more and more people want to do. And so it's about, for me, doing it in an intelligent way where you are aware of the trade-offs, aware by what it actually involves, and you're signing up for that and you're doing it in the right way.
What do you think are some of the things people can do to work out how much risk they could potentially put up with or tolerate?
I think there's two ways of looking at that. One of them is when thinking about, like, what I talk about, like the size of your three buckets, your protect, your maintain, and your improve. And so really it's like you've got to sort out your protection and work out like what you need there. Then it's like, well, where do you want to, what do you want to do with the safe bit? Where do you want to start to know you're going to get to by the time you stop working? If you're going to stop working, maybe you're not, after some of the conversation earlier, but if you are, what do you need to do to make that happen? And then what you've got left over is what you've got to play with risk wise. And the difference is, and it's going to be different for everyone. Some people are going to be willing to be less protected, have less bubble wrap around their life, and or people are going to be willing to go like, I'm willing to take my base case for I'm going to be at retirement as being lower, so I can put more into this thing that has the chance of paying off. So that's one aspect of it. But the other aspect of it, I think, is, well, how up for it are you to actually put the time in? Because like, if you are if you are really into crypto, then the hours that you're going to have to put into it to do it well, it's not going to feel like work. It's going to be something that you want to do anyway. If you've got zero interest in crypto, then you should not be doing it because even if it is, like, even if you knew for absolute certain that it was going to be the best performing asset class by a country mile, you still shouldn't be doing it because you're just going to make yourself miserable and you're not going to do a good job of it because you're not interested. So I think you have to be, when it comes to any of these types of investment, you have to be thinking about, well, which one do I want to become a little mini expert in, and am I willing to put my time into it? And if the answer is none, then then you're back to the earning piece again and like finding a different way of getting there.
I think that's a really strong piece of advice, and it matches a lot of like the career advice that I've had from guests in the podcast as well. Doing things in areas that come naturally to you will feel a lot less like work to you than it will to other people. So, for
Mm-hmm.
example, if somebody absolutely hates public speaking, don't start a podcast. If somebody like me is quite extroverted, likes to speak to people, likes to do my research, and likes to ask questions and has curiosity, a lot of the time when I turn on the podcast, it doesn't feel like work whatsoever. So, of course, I'm more predisposed to be able to do it and show up and enjoy it. In the same way, if somebody has absolutely no interest in researching biotech or the pharmaceutical industry or the health industry or the tech industry, then these are not things that you should consider when it comes to stock investing or picking companies that might be the next unicorn, the next one that's going to really move the dial. And I think that's helpful for people to think about it across multiple domains in their life when it comes to this whole earning piece, but it also comes to the investing side of things.
Definitely. And the same goes for, again, a lot of the advice you see is around starting a business. Starting a business can be an incredible way, probably the best way of changing your life financially. But if you just hate the idea of doing it, then you shouldn't be doing it because it'll be make you absolutely miserable and you probably won't succeed. So, and even property, like, I'm obviously pretty pro property given my background and what I do. And I believe that in terms of the level of risk that you're taking on, the returns that you get over time can be tremendous. But some people just flat out do not like the idea of it. They can't get comfortable with the illiquidity or the hassle factor or whatever. So they shouldn't be doing it. It doesn't matter if you know if it's going to be the best. You shouldn't be doing it. And so, yeah, it's really about, if you want to have an outsized returns, you need to be putting in outsized effort and focus. And so you might as well enjoy it.
Totally agree. And I think that's the case for many of the things that we turn our hands to in life. And I think that's been a running theme of many of the guests that I've spoken to. Like, if you're going to turn your hand to something, the thing that you spend the most time on should be something that doesn't always feel like a grind. And it
Mm-hmm.
shouldn't always feel like you're kind of pushing against the hardest possible object, like a really heavy sled push all the time. Sometimes it should feel like you're gliding through a process, and that won't be the case every single day, but more often than not, there should be times where you're like, I actually enjoy doing this.
Yeah, exactly. And the hard part is because that's different for absolutely everyone, and it means you can't just copy someone else's strategy, whether that comes to investment or anything else in life. You can't just look at what someone else is doing and go, "Oh, that looks good. I'll do that," because you're a different person from them. So the really working out what you should be doing isn't about investments or the financial side or anything at all. It's about knowing yourself and knowing what you really want, and that is the hardest thing of all. That self knowledge is really really difficult. And so while that's what I think you need to do to succeed when it comes to the money part of your life, because money is so intertwined with your skills and your preferences, your abilities, your attitudes, all the rest of it. It's there's no getting away from it. You have to put in that knowledge to try and understand yourself as well as any of us can. And obviously that's something that you get better at over time as you have experiences and you learn from them. So you're not going to get this all perfect on day one. It's a process, and it's something that you should be getting better at over time.
Agree entirely, Rob. And I think that's a really nice note and action point for us to wrap up on, encouraging people to look within and maybe have a little bit of a better understanding of how they're wired. I've had tremendous fun in this conversation. And by the time this comes out on the 12th of January, your book will be available, I believe. Where
It
should
will.
people head towards?
So it's called Seven Myths About Money. You can pick it up on Amazon, in Waterstones, or wherever else. Or you can go to robdix.com/myths if you want to grab a free trial chapter and see if you like it before you commit.
Beautiful stuff, Rob. That'll be linked in the show notes. Thank you to you, and thank you to you, the listener. I'll be back to speak to you all again very, very soon.